All right, let's dive in. Today, we are tackling a theory that absolutely rocked the financial world. It's an idea that basically suggests that almost everything we think we know about picking stocks is just flat out wrong. It's called the efficient market hypothesis, and believe me, understanding it is going to change the way you see investing forever.
But first, I want to start with the one question every single investor asks themselves. Can you really beat the market? I mean, is it actually possible through some special skill or secret sauce to consistently pick winners that outperform everybody else? That's the big challenge we're digging into today.
So here's our game plan. First, we'll figure out what a perfectly smart market even means. Then we'll hear the arguments for why the market is so efficient. After that, we'll look at the big counter-argument, its very human flaws. And finally, we'll wrap it all up with a practical takeaway for you.
Okay, let's kick things off with Section 1. Before we can have this debate, we really need to get our heads around this core idea of an efficient market. It was a seriously radical concept when it first came out.
To make this super simple, just imagine a horse race. But this isn't any ordinary race. The second a horse eats a great breakfast, or its jockey feels a little sick, or heck, even a single drop of rain hits the track, boom! The odds on every single horse update instantly for everyone to see. Now, in a system that perfect, how could you possibly get an edge? You can't. There are no secrets. And that, in a nutshell, is an efficient market.
All right, so here's the more formal definition. The efficient market hypothesis, or EMH for short, says that a stock's price isn't just some random number. No, it's the perfect, up-to-the-second reflection of all available information about that company. And here's the mind-blowing part. If that's true, it means there are no undervalued bargains to find or overvalued stocks to get rid of, because the price is, well, it's always right.
Now, the theory actually has 3 different levels, kind of like a video game. The weak form is pretty simple. It just says you can't beat the market by looking at old price charts. Then there's the semi-strong form, and this is where the real debate is. It says all public information, we're talking news, earnings reports, all of it, is already baked into the price. And finally, you have the strong form, which makes the pretty wild claim that even private insider info is already in the price. Most people agree that one's probably a step too far.
So, for Section 2, let's really get into the arguments for why the market might actually be this smart. It's time to hear from what I like to call team efficiency.
The basic logic here is something called the random walk theory. Think about it. If a stock's price already reflects everything we know, then the only thing that can make it move is new information, right? And what is new information? Well, by definition, it's a surprise, a new product, a sudden lawsuit. It's unpredictable. So, if the cause is unpredictable, the effect, the stock's price movement, has to be unpredictable too. It's a random walk, not a predictable path. And the person who really nailed this idea was Eugene Fama, an economist who won a Nobel Prize for this work. He put it perfectly with this famous quote, "In an efficient market, there is no such thing as a free lunch." What he meant was, you just can't get risk-free profits. That secret bit of info you think you have, chances are millions of other smart people already have it too, and it's already in the price.
But okay, that's the theory. What about the real world? Well, this chart right here is maybe the most powerful argument for the EMH. Take a look. Over a long stretch, say 15 years, a huge majority, we're talking over 90% sometimes, of professional fund managers, the people who get paid millions to beat the market, actually fail to do it. They do worse than a simple, boring market index. It just begs the question, if the pros, with all their resources, can't consistently pull it off, what chance does an average investor really have?
But wait, that is not the whole story. Not even close. Let's pivot for Section 3 and hear from the other side, from Team Skeptic. They say this beautiful theory has one giant, fatal flaw.
See, the entire efficient market hypothesis is built on this massive assumption that we as investors are perfectly rational, cold, calculating machines. But the whole field of behavioral finance tells us we're not even a little bit. Real human beings are driven by emotion. We panic and sell when things get scary. We get greedy and pile into a hot stock. We follow the crowd just because everyone else is. Those are not the actions of a rational machine.
And you only have to look at history to see it. How does a perfectly efficient market explain the dot-com bubble? Yet companies with zero profits valued at billions of dollars, right before they crashed to nothing. Or what about the housing bubble that led to the 2008 financial crisis? These events look a whole lot less like rational pricing and a whole lot more like, mass hysteria.
Okay, so where does all this leave us? We've got two powerful competing ideas here. In our final section, we're going to bring it all together and figure out what this great debate actually means for your money. So, what's the verdict? Is the market smart or is it dumb? Well, the truth is, it's probably not perfectly efficient. I mean, bubbles and irrationality definitely happen. But it is extremely competitive and highly efficient. All that competition between millions of really smart people, all trying to find an edge, makes it incredibly hard for any one person to win consistently.
So what do? Well, the lessons from this debate actually point to a super clear strategy. Since trying to find that one winning stock is like finding a needle in a haystack, diversify broadly instead. And since it's so hard to beat the market average, why not just own the average? That's what low-cost index funds do. Since the day-to-day stuff is just random noise, focus on your long-term goals. And maybe most importantly, instead of trying to outsmart everyone, focus on the things you can actually control, like keeping your costs low and your savings rate high.
Which leaves us with this final question to chew on. Is the market a perfect logical machine, or is it a flawed emotional crowd? The real answer is, it's both. And understanding that tension, that constant push and pull between cold logic and human emotion, that's the real first step to becoming a smarter investor. Thanks for joining me.